Last week we discussed about the way the central bank operations impact on the economy, and at that time also we discussed about monetary policy for some extent. So I hope that anyway you have a sound background on this topic, because as I know that there is a major topic on money and monetary policy. So there is a, if you may have not taken that subject yet, there is a second chance for you to learn in detail under that subject as well. But I just have to assume that you all know about the money, basically the fundamentals of money, the topic of money. So anyway, that if you can't understand anything, that at the same time that you can raise hand, or even you can expose and ask the question in the class, or even you can use the text box, chat box. Okay, so so what is the monetary policy? So under the last topic also we discussed that it is actually one of the key responsibility of the central bank to conduct the monetary policy, and you already know why. Basically to achieve the price stability. I hope that you remember the mission. In the mission statement of the central bank, it clearly specified what is the ultimate objective of the central bank. In the mission statement, it is mentioned about the two key responsibilities of the central bank: achieving the price stability and also the financial stability, and also for what, why, to achieve the sustainable growth. So last week we discussed about how that monetary policy is, why it is important, and why an economy should have that price stability. If there is high volatility, how could it can be impact on the overall performance of the economic activities. Likewise, we discuss, and also we discuss about why it is important to have the financial stability and also the stability of the payment and settlement system as well. Right. So purely in this topic, we are going to discuss on the monetary policy. Let's see what it has mentioned regarding the monetary policy. Almost all the monetary authorities around the world are responsible to conducting the monetary policy, or to regulate the monetary system of their nation or the economy. So that there are different type of monetary policies can be there. But we can see when we are going to discuss about the monetary frameworks that I will tell you. Last week also that we saw what is the current monetary policy framework practiced by the Central Bank of Sri Lanka, and also what was the previous one likewise. And also we can see the different monetary authorities that they are using, but basically they are using the same kind of monetary framework and also the monetary policy tools, but time to time that we can see some deviations when we are going to discuss about the monetary policy tools of the other key central banks around the world, that we can compare the differences. That is another topic for us to have such kind of a comparison. Okay, so here you can see the modern central banks mainly focus on achieving price stability through it, although it has important financial stability as well. That we saw that in the Central Bank of Sri Lanka also we have two key objectives: economic and price stability and financial stability. But in some central banks that we know that they are purely responsible on achieving the price stability. And although they have that the other function or the other responsibility to maintain the financial system stability function, but they have given more focus on achieving the price stability. But in our case, that we cannot just tell that the monetary policy is more prominent than the financial system ability. We cannot say that. We at the time that we discuss about the functions of the different department of the central bank, that we saw under the second cluster that we discussed, that we discuss about set of departments are there established in the central bank to work upon the stability of the financial system. Okay, that we discussed about the bank supervision department, non-bank financial institutions supervision department is there. FIU, likewise, set of different departments are there which are working towards achieving the financial stability as well. So we cannot deny that responsibility as well. But in some central banks, that they have even more focus. Mainly their focus is on achieving price stability, because that in some countries that we can see, other than the central bank, some other authorities are also there to look after, to oversee the financial sector. But in our case also, we know that the central bank is a key financial regulator, but for the other type of institutions, the insurance sector, there is a separate regulator, and also that the stock market activities, there is another regulators there. But anyhow, because of the status of the financial sector or the nature of the financial sector in Sri Lanka, that we can see that more responsibility is on the shoulders of the central bank. Because why? That central bank regulates the financial institution which are having they are actually contributing more into the system. Okay, so that's why it is also important. But anyhow, so in the modern central banking, that we can see under the objective of achieving price stability, what their main focus is to maintain the inflation at low and stable level. So here in Sri Lanka also, we already discussed, it is the same. The structure of those roles, the responsibilities given, and the range of other functions vary between countries. That's what we discussed. That range of functions can be different from one monetary authority to other monetary authority. But basically, that key responsibility is more likely the same. As the main role of the central bank is achieving the price stability, so what we can see, action to affect monetary and financial condition with the aim of achieving the broader macroeconomic policy objective of low inflation. So already we discussed what are the broader macroeconomic policy objectives. So inflation is actually one of the key macroeconomic variable. And also last week we discussed why it is that much important to achieve the sustainable growth in an economy, and how it is impact on the other activities like consumption, production, investment and all. And we saw the link or the influence of inflation on the other activities. So, but anyhow, that price stability objective is actually that ultimate objective is broader than just maintaining the price stability, but also in the mission statement, the central bank also touched that part clearly to foster the sustainable growth. So now because of the point that we discussed during the last session, now you can understand why this much this is important that much. Okay. And also, when it comes to the monetary policy, that we can understand there are three critical aspects of effective monetary policy formulation and implementation. So basically, the responsibilities with respect to the monetary policy, we can identify three stages are there. Three key components are there. The first one is the formulation of the monetary policy stance and the determination of the level of the operating targets. Okay, so that the first part is that. First, that the central bank has to decide what is the monetary policy stance that should be followed by the Central Bank of Sri Lanka. So very recently, I hope that you have heard that the central bank tightened up the monetary policy after a long time, right? Since the pandemic situation, central bank eased the monetary policy at a very substantial level, and it was there that the same monetary conditions were there. The policies were maintained for a longer time period, and recently I will show you the press release. So you can see very recently the central bank started to tighten the monetary policy. Now you can understand why it is, and in the press release, I recommend to read that latest press release on the monetary policy, which is called the monetary policy review, right? You can easily find that. Even I'm going to show it to you. So in that, at every time, normally that the monetary policy committees, that they are having meetings 8 times per year in normal circumstances, so that we can see at the beginning of the year, here it is mentioned here, so that we are actually discussing the first aspect, right? The formulation of the monetary policy stance. So as I told, first central bank has to decide whether to tighten or ease the monetary policy, and then how it is going to be tight or ease the monetary policy. So there are some operating targets for those. So then central bank has to determine the level of operating targets. Okay, in the last session also that I mentioned about the operating targets. Right? So anyhow, today we are going to discuss again in detail, so you will realize it. Okay, this is the first part, and then the second part, day-to-day liquidity management. So you know now that when central banks set the monetary policy stance, the responsibility of the central bank to maintain it. Okay, so that because central bank is always giving kind of a guidance for the other economic agents to move in a particular direction, right? So that as I told you, why the central bank has to tighten up the monetary policy, if there is at the basic level, the basic reason is why, if there is a trend, increasing trend in the inflation, then the central bank take measures to reduce the money supply. This is where central bank to follow the tighten monetary policy stance. Okay, so then after central bank change the monetary policy or establish kind of a monetary policy stance, the next thing is central bank has to control the system within that framework, or in order to manage that, because central bank it determines the level of operating target and all. So in order to maintain those target levels, that central bank has daily monitor the situation, especially the level of money supply, which is called the liquidity management. So daily basis, central bank monitor the conditions in the market and accordingly take measure to maintain the formulated monetary policy stance. And as well, The other part is policy, communication, and commitment. That communication part is very, very important, because we already discussed that how that the inflation, that future inflation, it basically depend on the perception of the people. We discuss about that, right? So that while changing the monetary policy stance and all, the central bank is try to control the perception of the people as well. In order to do that, definitely the communication also should be there, so that time to time the central bank is announcing to the public the policy measures taken by the central bank. That's why we can see that after change the monetary policy, even though central bank is not going to change the monetary policy, as I told you, there is a there is a usual that there is a trend actually, so that when central bank is changed the monetary policy, actually at the beginning of the year, central bank declared its roadmap. So in the roadmap also, central bank try to announce the people what kind of a policy measures will be taken by the central bank throughout the year. And also central bank announced the monetary policy calendar as well. So as I told you, there are in usual consumptions that in the normal condition, right? So circumstances that central bank is conducting the monetary policy committee meetings at 8 times per year, and the recommendations to the monetary policy committee, that actually the decision, all the decisions taken by the committees to be approved by the monetary board. So once the monetary board approve any policy changes, the next step is to announce it to the public. Okay, so that all the economic agents that normally that they follow the policies, because they know that when the central bank is going to change the policy interest rate, as an example, that they know that it will impact on the market interest rates as well. Likewise, that it is one of the responsibility of the central bank is to announce the policies. Then only that central bank can expect that the economic agents will follow or react to the monetary policy changes. That's what actually the expectation is. Okay, and also the commitment means what? That when the central bank declared their policy decisions, that central bank has to commit on it in order to maintain that, in case that central bank is going to maintain a tight monetary policy, so always that central bank has to work towards that. The central bank has to take measures toward that, and the central bank has the control over the overall functions which is relating to the monetary aspects in order to achieve that set targets. Likewise, that we can understand it is a process actually. Step by step process is there in conducting the monetary policy. Okay, so here you can see how this responsibility has been given to the central bank by the Monetary Law Act. So the central bank commenced its operation on 28th August 1950 under Monetary Law Act. So that central bank is responsible for conducting monetary policy to achieve the price stability. MLA of 1949 empowers central bank to conduct the national monetary policy of the country. So central bank has a clearly defined framework to achieve its main objective. So by doing so, what central bank actually doing? Influencing the availability of money or the price of the money. Last week also I mentioned that thing. There are two ways that central bank can influence the monetary aspects. One is changing the money supply or the liquidity level of the market, which is the availability of money, and the next thing is the price or the cost of the money. So you can see that money supply is the level of liquidity actually, that the cost of the money is the interest rate. Okay, so then what is? Okay, so accordingly that you can understand that central bank is responsible for conducting the monetary policy in Sri Lanka, which involves setting the policy interest rates and manage the liquidity in the economy. Okay, so that's what actually the central bank can do by conducting the monetary policy, setting the policy interest rates. So we are going to discuss about that, and also managing liquidity in the economy. Okay, but what is the objective? The objective is to keep inflation at low and stable level. Okay, it is there. And the other thing is, as I told you, now the central bank is following monetary policy framework. Okay, I think that there is a separate slide for that to discuss. Okay, so this slide actually last week also we discussed. So here in this slide that you can understand clearly how the money here basically how that monetary policy can influence the inflation in the country. So that monetary policy is one that so that I told you that by conducting monetary policy, central bank can do two things. Okay, so the first thing is what? Setting the policy interest rate, which is called the policy interest rate, means that actually the cost that you saw, cost of money. And the other thing is managing the liquidity, changing the liquidity or the money supply in the economy. Okay, so these are the two ways that it can do. But we know that money represents the purchasing power. Last week also that we discussed, anyhow, I'm telling you again. So this is very important to understand the relationship between the monetary policy, money, and how it is going to be impact on inflation. So the money represent the purchasing power of the people. When you have more money, you have more power, purchasing power. So you are going to demand more and more goods and services. So the aggregate demand will increase. So prices push up. Okay. So when there is less money, if there is a mechanism to control over the money supply or the liquidity or the availability of money in the system, so that central bank can change the purchasing power of the people. So that's how that central bank effect on the aggregate demand. So we know that when the aggregate demand changes, it will affect the price level in the market, right? Because last time also I described that the other market force is not other than the aggregate demand, aggregate supply is there. So the aggregate supply and the aggregate demand together determine the market prices, right? But here that we know that the supply side is not basically, if there is no any, but anyhow that the is no that central bank has no control over the supply side factors, only the demand side factors. Because why? That demand side factors are only associated with the money. So being the monetary authority, central bank has control over only the money. That's why. Okay, so sometimes although central bank try to control inflation by through the monetary policy, sometimes we can see that will not be effective at the expected level, because why? Suddenly some supply shocks can be there where that impact on the price levels. So sometimes that it can be there. As an example, time to time that we know that some natural disasters are there, some external shocks are there, where sometimes that we can see some supply side shocks as well. But anyhow, normally that supply side shocks are also that it is not the short term, it is not a short term variable. Basically, we can see that even though if something happened to the supply, as an example, that when we consider the agriculture sector productions, if there is more rain or if there is no rain, there can be impact on the supply. So in the short run also that we can see some fluctuations, right? Especially for the fresh vegetables and fruits like that. But that, you know, when it comes to the inflation, that inflation is a, you know, how to measure inflation. It is not just one single goods or the product. It is the basket of items. Okay, so that there can be impact on the overall price level, which is represented by the inflation. But what I wanted to stress that the monetary policy measures actually impact on the demand side factors, because why? That aggregate demand is associated with the money. That's how. Okay, so that monetary policy focuses on changes in prices driven by the aggregate demand, which is associated with money. That's what. Okay, therefore, it is directed to manage the aggregate demand to maintain the stability, but not the aggregate supply. Okay, this is also important point to remember. Since changes in money supply lead to changes in aggregate demand, the monetary policy is considered as a demand management policy. That's why that monetary policy is called demand management policy, because it is only impact on the aggregate demand. Okay, so then what? The monetary targeting. Oh, yes. So that since early 1980s to 2015, that monetary management in Sri Lanka is based on the monetary targeting framework. This is what actually mentioned in the website of the central bank. So until 2015, central bank follow monetary targeting framework. Okay, and that the reserve money was the operating target, and the broad money was the intermediate target. Okay, so that monetary management, which was based on the monetary targeting framework. So this is the monetary targeting framework. Okay, until 2015, that's from 1980s, the central bank followed the monetary targeting framework. Okay, so you better to have an understand about the monetary targeting framework, and also the new inflation, flexible inflation targeting framework as well. So the last week also I explained you why the central bank has to transfer from monetary targeting framework to the inflation targeting framework. Okay, so anyhow that today I'm not going to discuss the point again, but you must remember since 2015 that central bank is now practicing the flexible inflation targeting framework. Okay, so what is the monetary targeting framework? As I told you that we can see that monetary aggregates are there. So the reserve money was there as the operating target, and the broad money was there as the intermediate target under the monetary targeting framework. So here that in this framework, we can see there is a very key assumption is there when central bank is implementing this framework, which is here I have mentioned that all other factors are remain constant, means only the money supply has an immediate impact on inflation, right? So based on that assumption, this framework will work. But we know in practically there are different type of other factors are there in addition to the money supply that can impact on inflation. But under this framework, that is one of the limitation of that monetary targeting framework actually. There are many other factors are there actually. And also, as I discussed with you, now it is more challenging for the central bank to manage with the money supply because of that the credit creation process of the commercial banks and also the new innovation and all that. You know that it has become a very challenging activity for the central bank to you know that set the targets that we saw that monetary targeting was there under this framework, but it is really difficult to set the operating targets, right? That is one of the reason. Okay, so as I told you that there are many other factors now, so that in broad aspect that is so that anyhow that monetary framework that it has an impact on the aggregate demand. Even in the aggregate demand side also, that we assume that money supply is the only key factor impact on the inflation. But other than that, there are many other factors are there. So one of the key such factor is demand for money. So what is the demand for money? So this is also a little bit confusing concept for many of the people. So you have to get this point clearly. So the demand for money, when there is a high demand for money, okay, so which means that actually people like to hold more cash than expense them. Okay, so that is the easy way that you have to remember. The demand for money means that change in demand for money affect the, all right, it is the next part. Okay, so the first thing is that you have to understand what is the demand for money. People demand more cash to hold, means that people love to keep cash without using them to okay, so yes, so when there is more demand means that people love to keep money with them. They like to hold cash more than using them to buy goods and services. So we can see when the demand for money is high, there is a less demand for goods and services. So likewise, we can see that that demand for money and the aggregate demand, that two type of variables, we can see there is a negative relationship, which means that when demand for money is increasing, aggregate demand is coming down. Okay, so this it is the simple explanation for this sentence in this bracket. Change in the demand for money affect the aggregate demand negatively, means when the demand for money increasing, aggregate demand decreasing. It is like that. Okay, so here there is an example as well. When demand for money goes down, okay, here one of the thing that you have to understand. Okay, now that what the central bank is doing under the monetary target is basically under the monetary policy, the central bank thinks when you are going to cut down the money supply, okay, let's assume that there is the inflationary pressure is there. So that central bank assume that when we are going to cut down the money supply, it will impact. It will arrest the inflation. How that bank is cut down the money supply. So less availability of money in the market. So aggregate demand will get down, so that inflation will come down. Okay, or in the other way, if that central bank needs to boost the economic activities, at that time central bank thinks that better to increase the money supply. So that central bank is going to increase the money supply, and accordingly the inflation, that the price levels also should be adjusted accordingly. But if that demand for money, okay, it is kind of a variable in between the money supply and the market factors, right? Aggregate demand basically. Okay, so here you can now understand the example when demand for money goes down. Okay, so let's say that we cannot see that even that being this monetary authority, that it is very difficult for the monetary authority also to grab this impact, right? Demand for money goes down means that people are not willing to hold their money with. Okay, demand for money goes down. Then central bank takes contradictory, that means that central bank is going to tighten up the monetary policy, contractionary measures to curtail aggregate demand, which means that there is inflationary pressure is there. So central bank decided to cut down the money supply to down the aggregate demand. Okay, so at that time central bank adjusts the monetary money supply. So, but it will not impact in the same way that central bank expected, because by there is a less demand for money at that time. So it can verify the effectiveness of the monetary policy fully or partially, because it induces aggregate demand, because at that central bank thinks when central bank is to cut down the aggregate demand, it will change the aggregate demand. Okay, but at the same time, if people going to change their willingness or the demand for money, which means that here at the same time central bank changed the monetary policy, okay, that people's people's demand for the money also they change. So now there is a low demand for money. At that time, that earlier they were holding cash, they would like to hold cash, but now it has been reduced. So even though central bank cut the money supply, because now that demand for money has gone down, so it will increase the aggregate demand, so that even though central bank expected to curtail the aggregate demand, but it will not going to be impact in full. Okay, so that it is not going to work in full. Maybe sometimes it will work in a half a way. That's what it means. So this is one of the example where that central bank monetary policy also will not be effective in 100%, because there are some other factors as well impact on aggregate demand and also on inflation. Okay, so it is assumed that demand for money remains fairly constant, at least in the short term. So under the monetary policy framework, so the central bank has to assume that a demand for money is not going to be changed. It is going to remain at the same time, which means that even though the money supply is going to change, that people they have kind of a willingness to keep cash, the form of cash with them without expending them, no? So that willingness will be remain fairly constant. That what the other assumption. So another point here, that monetary policy does not deliver immediate results, but with time lags. So this is the other thing, that once the central bank change the policy interest rates, or money supply, so these are not going to impact on inflation or the aggregate demand overnight. It will take some time, and we are going to discuss about the monetary policy transmission mechanism. So we can see there are different channels how that policy changes are going to transfer to the market. Okay, so as an example, that when the central bank is going to change the policy rates, okay, so that the general public, that they are not going to deal with the central bank, so they are basically dealing with the commercial banks to meet their financial requirements. So that you can understand, no, that the policy rates are first going to impact on the short-term markets. Okay, so that then they'll convert or transmit into the market interest rates. Okay, so and also it will take some time to transfer those policy changes into the capital market, first into the money market, because it is the short term market. The capital markets are the long term markets, so that we can see that they will transfer the changes, that they will impact on the interest rates in the market at different type of markets, but it will take some time. Okay, that's what it means. Okay, then we are going to discuss about the inflation targeting and flexible inflation targeting. So that in the monetary policy, we saw that level of money supply is used as the intermediate target. Okay, as I told you that yes, that okay, so where it is, that reserve money that central bank used as the operating target, and the broad money used as the intermediate target under the monetary targeting framework. Okay, so that that monetary aggregates were the targets to achieve price stability under the monetary targeting framework. But inflation target is different thing. Okay, that it is basically a model-based framework, so that it targets a specific rate of inflation announced in advance, which means that there should be a mechanism in place to predict the future inflations, so that past and present inflation trends are very closely and critically analyze and predict the future trends. So accordingly, that central bank can that there are some predictions. So in advance, central bank announced that this is the rate of inflation which is going to be maintained by conducting the monetary policy. So likewise, now the Central Bank of Sri Lanka is practicing the same framework, where in advance the bank is announcing that. So that at present, that central bank has announced that to maintain the inflation at mid-single digit level. So it should be around 5%. Now we can observe that recently. Now, if you go and check the official website of the central bank, you can see at the top right side of the site that you can see that all the key variables are specified. Even when you are going to touch it, that you can go inside and see all the relevant documents with the necessary relevant graphs, and also you can see the trend of inflation. So you can say that there is a clear upward trend is there, and it is indicated as around 6 point something. So that you can see that in the recent past that there is an increasing trend. So the central bank has declared or announced that to maintain it at single level rate, which means that around 5. So that's why then when there is an upward trend, then central bank has to change monetary to maintain that level of inflation. at that level. Okay, so that it is the inflation targeting framework. Okay, so that monetary policy stance is driven by the target inflation rate rather than target rate of monetary growth. So this is the key difference in between these two frameworks. Okay, so now there is the target inflation rate is there. Now in almost all the monetary authorities, especially the developing countries, that they are having inflation targeting frameworks. They are, and also in addition to the inflation, that they have targeted the GDP growth level as well. In some countries, that they have a target unemployment, the employment rate as well. That when we are going to discuss about the policies of the other central banks, that you will see it. Okay, so here we can see that now we are also following that type of a framework at the moment. Okay, so then what is the flexible inflation targeting? So the flexible inflation targeting framework is concerned about both inflation and output compared to strict inflation targeting framework. So under the inflation targeting, that purely the target is on a specific rate of inflation announced in advance. But here, when it comes to the flexible inflation targeting, that the concern is on both inflation and output. Okay, so here also that the same way, that very comprehensive and standard that data or the model-based framework is necessary in order to have the predictions of inflation, or that central bank has to predict the future inflation rates. So while conducting the flexible inflation targeting, what central bank is doing is try to minimize the deviations of projected inflation rate. Okay, so that's what that central bank is practicing at the moment. That central bank is following the flexible inflation targeting in Sri Lanka now. So that, as I told you, that there is a specific rate of inflation has been announced. Okay, mid-single rate, so that in future, according to the projections, if that inflation rate is higher than that, okay, so that's what that central bank is trying to minimize that deviation by conducting the monetary policy. So we know that there should be a cut down. There should be a cut down in the money, and also to increase the policy interest rate in that respect. If there is a increasing trend in inflation, which means that we have predicted it to be in the mid-single level around 5, that when it is going to be 6, 7, 8 like that, we have to tighten up the monetary policy in order to achieve that target level of inflation. So likewise, that by conducting the monetary policy, the focus is to minimize the difference between that. So anyhow, that by conducting monetary policy, that central bank has to, if it's a high increasing trend, that central bank has to get down the inflation rate to the projected or the target level. Okay, that projected inflation is now high in the future. So that's why that central bank has to take it down to the target inflation rate. So it is the inflation targeting framework. And also, in addition to the inflation rate, that aggregate output is also one of the concern. Okay, so what it is, that we know that normally the GDP growth rate is the output, the aggregate output, that we can measure the performance of the aggregate output by using the GDP growth rate. So that there is the expected level of output, which is the potential level. That the potential means that what, that it should not be the what very what it is called, that it is actually be at a level can be achievable. right? But we know that really that even in Sri Lanka also that we are not at the potential level of growth. Okay, we are at a very lower level because of the pandemic also, that we have our economy has a very substantial downturn. Even earlier also, before the pandemic also, that we saw that our potential level is higher than that, but the real output level is lower than that. So if we know what is our, it should be not that much of ambitious level, which means that if we can even target it at a 9% like, but it is not achievable, right? So that sustainable level means which is the potential level, which means that we can maintain it at a level where we can over time that we can maintain with that rate, which is the potential or the sustainable level of output. But when there is a low rate of output, that one of the responsibility of the central bank to conduct the monetary policy in order to foster the growth as well. Okay, so it is actually the second concern of the monetary policy, not only the inflation targeting. I hope that you can understand. If you have any problem, you can ask. Okay, so that's what the flexible inflation targeting. Okay, so then we are going to discuss about the monetary policy instruments. So here I have mentioned those. Here I have mentioned some of the instruments, and also in the bracket you can see it mentioned those are conventional monetary policy instruments. So it shows us that there are unconventional monetary policy tools are there as well. Okay, so we are going to discuss about those unconventional monetary policy in under another topic. Okay, so basically here I have mentioned the conventional monetary policy measures or the monetary policy tools used by the Central Bank of Sri Lanka. But we can see that because of a specific situations like that in the pandemic scenario also, and also before that we can see many countries that because of the financial crisis, that you know that very recent the crisis was in USA, that it started in USA in 2009. Because of that, they have to take some extraordinary measures. The Fed Reserve Bank is the monetary authority in USA now, so that they had to take several extra policy measures to support the monetary system because of that financial crisis. As in the same way that we can see some extraordinary measures taken by the European Central Bank as well, that we are going to discuss later. And in this health crisis, because of that health crisis, even the Central Bank of Sri Lanka also took some extraordinary measures to boost the economic activities of the country, other than the monetary policy instrument, because sometimes that as we saw that sometimes that monetary policy instrument that they take some time to give the impact in real economic activities. So at that time, some special measures has to be taken to revive the economic activities in countries. So likewise, that we are going to discuss about such unconventional or extraordinary measures later. But here our focus is on these conventional monetary policy measures. So basically, we can categorize this instrument into two: quantitative and qualitative measures. So that you can see under quantitative measures that open market operations is one of the way the central bank can actually that open market operations use to manage their liquidity positions in the market, and the policy interest rate is another policy tool. and also the statutory reserve ratio is another policy tool. And when it comes to the qualitative side, that we can see the moral suasion as the instrument. Okay, so that open market operation, policy interest rates, those instruments are focused on the money supply and the money multiplier. Impact on the monetary base is that it is kind of a that monetary aggregate. Okay, that I hope that you have learned everything under the subject of money and monetary policy, and that money multiplier is also a concept relating to money supply, where that other than the money or the reserve money, okay, that commercial banks can create money as well, that bank money, that credit creation process you may have heard. So accordingly, that we can see that other than the reserve money or the currency issued by the Central Bank of Sri Lanka, by using the demand deposits, that commercial bank can create credit. How many times that they can do that process is relating to the money multiplier. So that the statutory reserve requirement is actually can impact on the that money multiplier effect. Okay, that is why it has mentioned here that focus of the statutory reserve ratio is on money multiplier. Okay, so that the other two instruments, open market operation and policy interest, that they can impact on the level of liquidity in the market. Okay, so then we are going to discuss about the open market operations. Okay, so at here there are few technical aspects that we have to look into, but I hope that you can understand. You cannot understand, you can raise questions. It's okay you to ask questions. So yes, one has asked, has this tude given to us? Yes, I think already, because the thing is now that that BSL has already I think uploaded all the materials, right? So that you can see. But here actually this I can't remember, but you please go and see among the files uploaded by the IBSL. Hope that you can find this material as well. But you can see time to time at the same topics that I'm discussing at this time also. But the tudes that I have already provided the last time, so that they have, I think, all the bulk they have already been provided there in the portal. You go and see. And the last, remember that with respect to the central bank balance sheet, actually that today I sent the IBSL to upload it. So it is actually the new material that you have to go through, not the one that I have provided earlier. And also in addition to that, I sent IBSL some additional notes on the departmental activities of the central bank, because at that time that I told you, we have limited time to discuss all the functions of the central bank, but finally I decided to give some more information on two departments, so that additional note on these two departments, and I asked IBSL to circulate that note as well with you all. Okay, so you better check. This material should be available there. And at the same time, I also can check with IBSL whether they have circulated this one as well. Okay, that's one of the question, and the other one is please accept. Okay, that we are going to discuss about the moral suasion later. One by one, we are going to discuss about the monetary policy tools in detail. Okay, Maybe. Okay, that dispute that's somewhat different because I have mentioned few new points, but the same thing. There is nothing. But anyhow, that I will send this to IBSL and ask them to share. Okay, so don't worry. So that you know that when I'm getting ready to lecture, sometimes that if there are some new points that I try to add, that's why you can some few differences. The deviations are there than the material that you have already obtained from the portal. It's all right. So I will share this one as well. Okay, thank you. Okay, so this is about the open market operation. Okay, so let me check whether there are any more questions. Yeah. Okay, so okay, so that yeah. So now we are going to discuss about this instrument one by one. The first one is open market operations. The central bank conducts open market operation either by buying or selling securities. Okay, so now problem is actually that open market operations is linked with the money market activities. Okay, so that I have to just assume that you all know the money market activities. So that there are the repo market is there, and also there is a overnight call market is there, and the repo market is there. Two type markets are there. Both are short term markets. So that interbank call money market, right? It is actually the shortest, that with the shortest maturities. It is an overnight market where the commercial banks are interact among them to manage their short-term liquidity situations, to manage with their short-term liquidity requirement. Okay, I hope that can anyone confirm whether you have learned about that money markets, especially that you should have the understanding about the repo market and also overnight call money market. From whom I can ask. Utpala, are you there, Utpala? I know that definitely you should learn under the money and monetary policy, because it is that subject is mainly basically based on money and monetary policy. So that definitely you should know. If you don't have idea, I can add some two slides here and will explain you. Okay. So can anyone tell me whether you know about these markets? Okay. So no one is assisting me, so it's okay. So anyway, that here the open market operations. Yeah, yes. Yeah, thank you, Judy. So I know that you know, but I think that based on the background you have or the basic understanding you have on this market, when I'm describing this, that you can link back to your background knowledge. If you cannot understand, please let me know. Then I will explain accordingly. Okay. So that here we are going to discuss about the open market operations. Okay, so that I know that there are different subjects that you are taking. In those subjects that you may have already discussed about this topic, but here I am going to give you an overall idea of the open market operations. Okay, so basically what the central bank is doing here under the open market operations, actually this activity is basically focus on the managing the money supply or the liquidity level of the market. Okay, so that what the central bank is doing, central bank can either buy or sell securities. that here the securities, what are the securities used? That is basically the government treasury bills and bonds. So the bills that you know, less than 12 months, the maturity, the T-bills are the long-term, they are having the long-term maturities. And also that central bank can use central bank's own securities as well in the open market operations. The time span of most of the operations is overnight. When it comes to the overnight call money market, it is like that. Transactions take place between the central bank, commercial banks, and primary dealers. Those are the people who are interacting in this market, overnight market. So the banks are commercial banks, only the commercial banks, okay? The other banks, commercial banks only. And licensed commercial banks, okay? Then the central bank and the primary dealers as well. If central bank purchases securities, okay, so the domestic asset, that now you know we already discussed about the balance sheet of the central bank. When the central bank is going to purchase securities, that it is going to be an asset of the central bank. So it is going to be recorded in the balance sheet asset side under the domestic assets. Okay, so the balance sheet increases, but with corresponding increase in liabilities in the form of currency in circulation. So in the liability side, it is going to be recorded as a liability, currency in circulation. Why? That at any time, if central bank is going to issue currency, it is a liability for the central bank. Okay, so it adds to, but it is going to add into the market liquidity. So when the central bank is going to purchase securities from the commercial banks or the primary dealers in order to meet their liquidity requirement, short-term liquidity requirement. Okay. So when the volume of liquidity in the market increase, what will happen to the interest rate? When central bank purchase securities, okay, the central bank is going to purchase. So central bank is going to purchase means that central bank has to issue currency, so that it's going to add to the liquidity. Okay, so that liquidity in the market is increasing. So what will happen to the interest rate? So that we know interest rate is the cost of the money. Okay, it's the cost of the money. Like in the same way, in the goods market as well, when there is a more supply, let's just assume that there is a good market, okay? If take one particular good, let's say that mango, something that we know in the mango season that more and more mangoes are coming into the market. So what will happen to the price of the average price of the mango? It will decrease. Why? That more supply is there than the demand. So that mango price will come down. Right, here the money is not like mango, right, that there are some limitation in supply as well, but anyhow at a particular time when the market liquidity is going to be increased, mean that the market interest rate is decreasing because it is the cost or the price of the money. Okay, so unless the demand for liquidity increases to match this increased supply, okay, that in the mango market also the supply of mango is increasing, but at the same rate the demand for mango is also increasing, means that the price will remain at the same level. But normally know that there is a limit for us to eat mango, or even though that the more and more mango are available, basically we know that with respect to a particular good that there is a limit for us to consume. Okay, likewise that normally that mango price will decrease because that high supply, but the demand is going up because of the mango season, that all the people think that mango is there, so we need to eat mango in this season. Like, so demand will increase, but at a particular level that demand will stop. Okay, why? That there is a limit for the consumption. Okay, so that after that also, if the supply is increasing, what will happen? Supply is increasing, but demand is not going to change. So that the excess mango will get rotten, no, that no one is going to take them. It is like that. It's the same thing here explained. So that volume of liquidity in the market increase, therefore the interest rate decrease. Interest rate decrease if there is no corresponding increase in the demand. If the demand also increase in the same magnitude of the volume of liquidity increases, what will happen to the interest rate? Interest rate will change. Okay, so that is what the meaning of this sentence. But anyhow, in the short run, that we can see that by changing the volume of liquidity, there is a possibility for the central bank to change the interest rate in the short run as well. Okay, so that is the overall idea. The reversal happens when the central bank sells securities to absorb the market liquidity. If central bank the central bank daily monitor the level of liquidity in the market. We discuss about the domestic operations department in the central bank, and also there is a system that there is an electronic platform is there for all the markets to that they have to report their liquidity positions at the day, so that central bank can oversee the overall market liquidity levels daily basis. So accordingly, the central bank know that according to monetary policy stance, okay, practicing by the central bank, whether there is a high liquidity in the market, that central bank cannot maintain that policy stance. Let's say that, as I told you, that central bank recently tied up the monetary policy, which means that central bank has to control if there are any pressure on inflation. That's what the objective. So that it is the medium to long term objective of the central bank, because central bank has committed to the people to maintain inflation at mid single digit level. So accordingly, that central bank has changed the, we are going to discuss about the policy interest rate. So at the time that central bank announced the monetary policy changes, that central bank announced that the policy interest rates are this much. So that those are there as well in between that central banks too, because as you say that by doing operating the open market operation, also that central bank can influence the interest rate in the market. So that central bank has to commit to the policy measures, okay, that because already those are communicated to the public. So what the responsibility of the central bank now to commit this is communication and commitment. We saw that one of the aspects of formulating and implementing the monetary policy. So it is the responsibility now. So likewise, that central bank is trying to maintain the market interest rate aligned with the policy interest rate. If there is any trend that is still the interest rate is high or low, that central bank can accordingly adjust the liquidities as well. So by absorbing or injecting liquidity, it can influence the short-term interest rates in the market. Okay, so likewise, that central bank can here under the open market operations, actually that we can see there is a very active role that central bank has to play here, because central bank involved in these activities in the repo market. Central bank has a very active role to play by either buying or selling securities. Okay, so likewise that you can see when central bank purchase securities, the securities are coming to the central bank, inside the central bank. So it is going to be an asset. So asset side is increasing. For purchasing the securities, that central bank to issue or release some money to the commercial banks, the primary dealers. So those legal tenders are going out of the central bank. Okay, so that it is going to, what will happen? Central banks issue legal tender means that liability is also going to be increased. The other way will happen if central banks sell securities. When central bank thinks that there are more liquidity in the market than required, so at that time central bank issue securities, so that commercial banks buy those, so that excess liquidity is absorbed by the central bank. So the asset will fall, and also legal tender is coming into the central bank. So the liability side also, that we can think that there is a fall in liability as well. Okay, so it is the story. So here we can see what will happen to the interest rate. Okay, short-term interest rate because of open market operations of the central bank. So we saw that there are two ways that central bank can intervene to the repo market. Conducting open market operations, either can purchase securities or sell securities. Okay, let's say that here original level of demand. Here we are just assuming there is no corresponding demand there. So the demand is there. So the supply is there. So according to the demand and supply, the solid black color lines. Okay, that the short-term interest rate has been determined as I0. Okay, so that let's say that that central bank thinks that there is a what there is excess liquidity in the market. Okay, that's why that interest rate is also high at ISO level than the level that central bank expected. And also there are more liquidity available in the market than the level of liquidity should be there to maintain the policy stance of the central bank. Okay, so at that time that central bank is going to, what central bank is going to do? Central bank will sell securities. Okay, sell securities so that central bank can absorb excess liquidity. So the demand is not going to change. So what will happen? Okay, central bank is going to sell securities. I think that, hold on a minute, this two bars should be changed. Hold on a minute. Okay, so yeah. Okay, this is the correct diagram, not this one. Okay, so this is wrong. So we'll share this new presentation with you, the new materials. Okay, so sorry. So here we can see that there was the mistake, that it was wrong. So here you can see the correct impact of monetary open market operation on the money market. So as I described that here, that we can see based on the original level of demand D0. Demand means demand for fund. Okay, so the supply is zero, the supply. So based on the original level of demand and supply, this is I0 is the short-term market interest rate determined by this forces. Okay, so here the banks are interact in this market. So at that time, the central bank, if that central bank think that the interest rate is higher and not that much aligned with the policy interest rate determined by the central bank, and also why the reason is that here that central bank needs to get it down, because the reason is that high liquidity there, more liquidity are there in the market, that central bank can observe that liquidity position, as I told. So at that time, central bank decided to purchase securities. Okay, so that yeah, sorry, the sell securities. Let me check that when central bank going to purchase securities, that supply is going to be increases. Okay, so that's how that interest rate is coming down. When there is an interest rate, when in the market interest rate is high, mean that there is less liquidity is there than the required level of liquidity, because that as we discussed, that interest rate is the cost of money. Okay, so when we need money, but there are less money is available, so more demand for money than the required level of money. So the price of the money or the interest is then high. Okay, central bank monitor this situation, and there is no enough liquidity in the markets. That's why this pressure is there on interest rate. So at that time, central bank can purchase securities. So that's what you can see here. So when central bank is going to purchase securities, it will increase the money supply. Okay, so if the demand is not going to change, okay, if it is going to be at the same level, and if the money supply now has been increased because of central bank purchase securities, now there are more money available, more liquidity are there in the market. So we can see that interest rate is coming down, okay, because of high supply. Okay, increase in the supply of fund and the demand. So that is how it is going to impact on the market interest rate to come down. Okay, so that central bank is injecting money here. The supply is increasing. So if central bank think that more money is there, okay, so that at that time, that what the central bank is to do, that to sell securities. So likewise, that central bank can sell securities, means that central bank can create a demand in the money market for the funds. So likewise, that central bank can absorb liquidity into the market, so that demand increase represent that. Okay, so accordingly, this is the corresponding response in the market interest rate is going to be increased. That is how that open market operation works, right? These are the two activities that central bank can conduct, and accordingly how the market interest rates are going to change in the repo market. So this is one the diagram. Okay, so anyhow, that now I'm going to share this new document with you all. Okay, then we are going to discuss about the policy interest rates. So the policy interest rates, that we can discuss about three policy interest rates at the disposal of the monetary policy of central bank. Okay, before that, I think that you already know the difference between the policy interest rates and the market interest rates. Okay, so the policy interest rates are the rates determined by the Central Bank of Sri Lanka. Okay, so that it is predetermined or set interest rate the Central Bank of Sri Lanka. So the market interest rates, that these market interest rates, who is determined the market interest rate? Market interest rates are determined by the market forces. Okay, but that as you saw here, this is the open market operation in the repo market, that how the interest rates are determined by the market forces, the demand and supply forces of the repo market. Okay, so the market forces are determine the market interest rate, but you can see how central bank can influence on the market interest rate by selling and purchasing securities. Okay, so that policy interest rate and market interest are the two things now. Policy interest rates are predetermined. Hold on a minute. Okay, so that policy interest rates are determined by the central bank, which are predetermined market rate that already set. Okay, that market interest rates that we can see day to day in the short term markets, that they are changing. The capital market also, based on the demand and supply for the funds, that we can see the market interest rates are changing. But that policy interest rates that can control the market interest rate by setting those policy interest rates. So we are going to see how it is. Okay, and also that for the market interest rate also, other than setting monetary policy interest rate, that central bank can influence by doing the open market operations. Okay, that's what we saw, right? So, and other than that, central bank can even control the market interest rates by imposing caps over the ceiling of interest rates to the bank. Time to time, that we can see, that central bank issue regulations to the banks and other financial institutions to have some control or the cap over the interest rates for these loans. That should be the maximum interest rate, okay, offered by those institutions to the customers. Likewise, that even does authoritative influence also can be there. Okay, so but here that you have to understand the way that these policy interest rates and market interest rates are determined by the different forces. Open market operation is used to influence the market interest rate by influencing the liquidity situation in the market. That's what we clearly saw in this diagram. Okay, I hope that it is clear for you all. And the next one is policy interest rates are directly set by the central bank to influence the market interest rate. That's what I told you, that we are going to see why these rates are important and how the central bank influence the market interest rates by determine those policy interest rate that in advance. Okay, we are going to see that. So under the policy interest rates, that we can see there are three interest rates are there, policy rates are there. The standing deposit facility rate, the SDFR in the short form, a standing lending facility rate, SLFR, standing lending facility rate, and also the bank rate is there. Okay, so let's see what are those. The standing deposit facility and standing lending facility. What are these facilities? Actually, that rates are applicable for those facilities provided by the central bank. Okay, so these two facilities are maintained by the central bank to facilitate the short-term liquidity management of the commercial bank. Okay, so that we know that all the central banks, that they are dealing with their funds available to give different type of facilities for their customers. At the end of the day, that they will end up with a particular position of funds or the cash or the liquidity. So, and then they can understand what is their position in order to manage with the next day functions. If they think that their liquidity position or is not adequate enough for them to facilitate the function in the next day, that they are actually at a deficit. Okay, that means that there is a that their short-term liquidity position is not enough. Okay, so the other side is have some excess liquidity. At the end of the day, that they can realize that they have some excess liquidity. So likewise, that some banks that they can have some deficits, some banks that they can have some excess. So this is all about the commercial bank. Okay, so what they will do, that there should be a mechanism now to balance these positions so that they can interact in the overnight call money market, where the commercial banks are interact to manage with their liquidity positions, where that deficit bank can borrow from the banks who are having excess liquidity. So that in this market, it is actually the shortest time. This is an overnight market where all transactions are overnight happening based on the overnight basis transactions. So that that facility, that mechanism in place for the commercial bank to interact with each other to maintain or meet their liquidity requirements. Okay, so that they can interact and they can transact accordingly. They can have some transactions. Okay, so that these all transactions are again be seen by the central bank. Okay, so because that these banks that they are having that that electronic platform to do this transaction, so that system in place. Okay, so that alternatively that the commercial banks they can go to the central bank as well. If there is a shortage or excess, there is a facility for the commercial banks to either to borrow or either to deposit their excess with the central bank. Okay, it is actually the alternate facility provided by the central bank. Other than the commercial banks are interact in between them, even they can come to the central bank as well under this standing deposit facility and the standing lending facility. Okay, that they provide alternative access for commercial banks to manage short-term liquidity. If there is a shortage bank, that they come to have the service under the standing lending facility. Okay, deficit banks that they can have short-term securities accepted to the central bank at its disposal to use as a collateral. Okay, so in order to come to the standing lending facility, those commercial banks, they should have short-term securities acceptable to the central bank. That we know that what kind of securities are there. The government securities are there, and also central bank securities are there, which central bank use under the monetary policies. So that even that the commercial bank can use this type of securities and come to the central banks under the standing lending facility to borrow funds if they are having a deficit liquidity position. Okay, it is for the banks who are having a deficit, and for the who are having excess liquidity, they also can come to the central bank under the standing deposit facility, so they can deposit their money with the central bank on an overnight basis. Okay, so these are the two facilities. So the rates applicable, interest rate applicable for these two facilities are called standing deposit facility rate and standing lending facility rate. These two rates are associated with those facilities. Okay, so these two rates form a corridor of interest rates that help the central bank to stabilize the fluctuation of the short-term market interest rate and implement its monetary policy stance. Okay, that's what now then we are going to discuss about how that these I already mentioned you that SDFR and SLFR are the policy interest rate determined by the central bank, that these are set in advance. So now that the commercial banks operations are going on, and also we can see in the overnight call money market where the commercial banks are interact to facilitate with their short-term liquidity management, that in that market also that interest rate is there, okay, based on the supply and demand of funds between the commercial banks. So we are going to now check how these that these two rates are form a corridor of interest rate, okay, because that we are going to see how it is form a corridor of interest rate, and it helps the central bank to stabilize the fluctuation of the short-term market interest rate, so that in the market, okay, in the market that we can see here the market where all the commercial banks are going to interact with each other, and here that you can see at the right side that you can see the interest rate set by the central bank. Okay, so that SDFR is standard deposit facility rate. So it was at 4.5% during the pandemic situation, but recently still we are having the consequences of this pandemic, but because of that current development, considering that overall price level changes and all, very recently central bank changed the monetary policy stance, so then now that both the rate has been increased by I think 50 basis points, where it was first 4.5%. Now that deposit facility rate has been increased to 5, and here also it was 5.5. Now it has been increased to 6 points. So this is a present corridor of interest rate, right? So this is here. So that the deposit, when you are going to deposit, you know that the rate is low than when the rate applicable for the borrowing. So this is where the 6 is, where the 6% is the interest rate, policy interest rate applicable for the standing lending facility, which means that if there is a commercial bank who needs to borrow, that they have to borrow from the central bank at 6%. Yeah. Okay. Okay. So this is the deposit facility rate, where commercial banks who are having excess liquidity, that they can park their cash in the central bank at 5%. Okay. So here the banks are interact with other banks, commercial banks, to lend or borrow. Okay, so that we can see that interest rate can be anywhere. Okay, so but anyhow, because of this interest rate set by the central bank, always in this short-term market, we can see the interest rates are always, okay, set in between these two lines, or in between the corridor. I will tell why. Okay, let's say that there are some banks who are having deficit. Okay, so that they are representing the demand side. So they are the demanders. Here the funds are there. Volume of liquidity means the fund. Here the short-term market interest rates. So that who are having the excess liquidity are representing the supply side. Okay, so likewise, that demand and supply determine the short-term interest rate in this market. Okay, so let's say that if the demand is going to be higher than the supply, okay, or else that we can simply tell like that. So let's say that if in this market, short-term market, if the rates are going to be higher than this 6% rate, okay, so this is the lending facility. If this market determine the rate anyhow, because of that high demand than the supply, we know that when the demand is higher than the supply, there is a pressure for the price to increase. The same thing apply here. No? So in that case, that interest rate increase in the short term market. So that if here that you can see that original demand is DL0. So if the demand increase up to DL1 level, so accordingly the interest rate is also going to increase. So now you can see that the I1 level interest rate is higher than the 6% level. So if there is a facility available for the shortage banks who are representing the D0, okay, if there is a way or if there is a channel is there available for them to borrow money less than I1 level, which is here. So the central bank is providing that facility at 6%. So even that in the market, short-term rate is now I1, which is higher than that 6% level. So what do you think? If the banks are rational, they definitely not going to borrow from other surplus commercial banks. Instead, that they can come to the central bank and they can meet their short-term liquidity problems, okay, at this rate. But the condition is that they should have or the securities accepted to the central bank as the collateral. That is what the condition. So in order to borrow under this SLFR facility, that they should have collaterals. So the commercial banks, even though that they are having liquidity issue, so if they have collateral, so they can come to the central bank at 6% rate. So this line, what will happen to this line? So because they are not anymore going to represent the demand side of this market, they are coming here. So what will happen? This L, this line, okay, this line is coming down again, okay. So that we can see that interest rate is accordingly set a line or set under this 6% level, because no one is going to borrow money at a higher rate if there is an alternate facility is available at a low rate than that. If there is any other restrictions, that they can go for higher rates to borrow money. So in the same way, the other way also can happen. So here that initial level of interest rate set by the market is 0, where it is actually in between the corridors of policy interest rates. So no problem, that bank is willing to transact in this rate, okay. But in case that the demand is here, that there are more and more surplus banks are there. So than the demand, there is a supply. So what will happen? That market interest rate is determined where this new supply line and the demand side is intersect where. So that here's the point. So accordingly, the market interest rate is here, I2. So but at that level, you can see now there are more suppliers. Okay, so that there is a facility for them to deposit their excess cash with the central bank at 5% level. So when there is a facility available for them to have high return than the interest rate determined by this market, that these commercial banks are not going to play in this market anymore. So they will come to the central bank and deposit their excess liquidity overnight basis at 5% rate. Okay, so likewise that we can see by setting up this interest rate SDFR and SFR. So what central bank can do? Central bank can control the market interest rates set by the short-term markets by the fund supply and demand. But here you can see that the interaction or influence of the central bank into the short-term money market is very passive. That central bank is not going to represent any supply or the demand side like in the repo market that we saw here. That central bank is going to represent either the side of demand and supply by selling and purchasing the securities. But here you cannot see that type of activities there. The central bank, that role is very passive here. That central bank is not going to practically not going to involve in the market, but by just setting the market policy interest rate at a side, that it just set at a side accordingly, that the short-term market rates are controlled. Okay, so that's how by changing the policy interest rates, that central bank can change the market interest rate. Okay, earlier it was 4.5. It was like that. So that up to that level, that short-term market rates can be fluctuated. So that by setting up this corridor, that central bank can guarantee that in the short-term market, that market rates are fluctuate only among these two, only this path only between 5 to 6. So accordingly, that this is the short-term market interest rate now. So this is basically where the market determine the cost of funds available for the commercial banks. Okay, so that commercial banks are actually, as I told, that in the financial system, that they have a very dominant role to play because they are contributing to the large amount of assets in the financial system. So that they can influence the system in a very high magnitude. So their influence is there. So when the market interest rates applicable for these commercial banks to have funds, okay, that it is actually influence on the other interest rate applicable for the other type of activities involved by these commercial banks. That's how these rates are influencing the other market rates. Okay, hope that you can understand it. Any problem up to now? Let me check there is any other. Okay, so one has mentioned that he hasn't done that subject yet. So hope that you all can understand that I try my best to explain even without having that background, that I hope that you can understand. Can anyone please tell me whether you can understand? Okay, let me thank you for confirming that she said that yes, she can understand. What about the others? Do you want me to explain again, or can you understand? Oh, yeah, Chandi. Chandi. Okay, yeah, she's asking for me to explain again. Okay, so I'm going to explain again. So after this explanation, that we can conclude a lecture for the today. So because it is almost 5:26, but I was little late to come to the class because of that issue in logging. So anyhow, so I'm going to, is that all right me to explain this slide or the previous slide as well, Chandi? Or only this slide?
Yes, means
Chandi?
both.
Okay. Both. Means that repo market also again? Okay, so that here, this is the one instrument, okay, that it is the open market operations. Under the open market operation, what you have to understand is that central bank can influence the interest rate in the market by changing the money supply. Okay, so here you can see very active role is there for the central bank to play, because why? Central bank can either purchase securities or sell securities, and that you have to understand in which scenario central bank has to sell securities and for what purpose central bank has to purchase securities. Okay, in case there is excess liquidity in the market, central bank has to sell securities. Okay, sell securities to absorb that excess liquidity. So at that time, central bank is going to sell securities, which means that central bank is going to create a demand for the funds in the market. So that's why you can see that line is there. So because of that, if say that the supply is at the same rate, what will happen? That interest rate is to be increased. Because why? That central bank sell securities means absorb some money inside to the central bank. So the availability of or the liquidity, volume of liquidity in the market is going to be now what? Down. So that's why that interest rate is increasing. Because why? That interest rate is actually the cost of money. Okay, when when there is that cost of the money, so that when there is a higher demand than the supply, we know that cost is getting increased. So that's how that I0 is increasing to I1. The other side is when the central bank observe that there are less liquidity available in the market, so need to pump or inject more liquidity. At that time, central bank is going to purchase securities. So that central bank is going to represent the supply side. Okay, the purchasing the securities that central bank can issue legal tender or the liquidity or the money. So at that time, we know that there are more liquidity than the required level. The demand is at the same rate, D0. So you can see accordingly that I0 is coming down to I2. So that's how the open market operation works. So this is one of the instrument at the disposal of the central bank to conduct the monetary policy. Okay, so this is the first instrument that we discussed. Okay, so that here you can see by changing the level of liquidity that central bank can influence the market interest rates. Okay, here what it is. Okay, so that it is the story about the open market operations in a very simple language. But when it comes to the practical level, this is that much easy for us to just see like this kind of a diagram. Okay, so this is a very simplified version of the diagram that I can explain you the story. Okay, so then we started to discuss about the that we have done with the open market operation. So then we moved into the second instrument, policy interest rates. So under the policy interest rates, there are three type of policy interest rates, that is standing deposit facility rate, the standing lending facility rate, and the bank rate. Okay, so then we discuss about this first two. Okay, so here that it has explained you what are these two facilities. Okay, so I told you that the banks, if there is a liquidity issue, deficit for a particular bank, commercial banks, that there is a two options. That this is a simple way that I can explain you the story. Okay, so let's say that there are two options they have. Either they can go to the that overnight call money market, interbank call money market, or if the rates are higher in the short term market, Okay, so that if they can observe that central bank is also providing the facilities for them to deposit their excess cash, or when they are in a deficit situation, that central bank is the facility for lending. So they know the rates, because those are policy interest rate predetermined by the central bank. So those interest rates are very well known for all the commercial banks. So it is like preset. So at the same time, that market is also activating. Sometimes that you can see here, sometimes that market, when the market is determine the interest rate in between the corridor, right, in between corridor, that there is no influence for the commercial banks to go to the central bank. Why? By either way, it is more favorable for them to transact in the short-term market. Why? If the market interest, let's say that in the short-term market, the rate is I0, at that time we can clearly it is favorable for both surplus banks as well as the deficit banks. Why? Because you can see that for that surplus bank, it is more favorable for them to stay in this market. But for the deficit bank, in order to have the facility of lending, that even it is better for them to, for the deficit bank, it is favorable for them to borrow from the other commercial banks here, okay, in this market, if the rate is I0. But for the surplus banks, actually, that yes, that even it is favorable for them to go for that, right? What do you think? That this is a deposit rate of 5%. So it is also higher than that in the market also, that rate is higher than the deficit rate. So it is favorable for them to go and what they are going to deposit. So they can lend at a higher rate for the deficits bank. So in either way, for both parties, that it is really favorable for them to interact with the other commercial banks than go to the central bank. Okay, so can you understand that part? Right. So here, what the purpose of the central bank is to ensure that the market interest rates are not going to fluctuate. Okay, fluctuate beyond the lines or the corridor set by the central bank. Okay, any problem?
Madam, I2 means
Hold on a minute here. The I2 here. Okay, we'll explain again. Okay? So here the short-term market. Okay, in your left side, there is that you can see this diagram here, that you can see this is the short-term market. As I described, that where the commercial banks are interact in order to meet their liquidity shortages, or any surplus is there that they can either lend or borrow from other central banks. Okay, this is the market where all banks are interact. So let's say that first, based on the demand, original level of demand, based on the original level of supply in this market, that market short-term market rate has been determined at this level I0. Okay, so as I said, that it is actually favorable for both sides of the banks as well as for the central bank, that it is not an issue. Because why? That central bank can easily see that the short-term market determined by the market forces are in between this corridor, where that central bank has set the interest policy interest rates. So central banks want market interest rate to be in between this line. So it is not a problem for the central bank. So no need to worry about that. So as expected by the central bank, that market is aligned with the monetary policy stance. So no worries at all. Okay, but at that time, let's say, okay, in that now that at a particular time, okay, so that there are more commercial banks are having shortage of liquidities, so that we can see that this balance we can see now, because why that there are more demanders are there, because most of the commercial banks are having shortage of liquidities, okay, than the surplus banks. So then the supply, now the demand is increased. Okay, so here, not this line, here. So what will happen? The supply is at the same level, but the demand has now increased because that there are more commercial banks are having deficits of liquidities, shortage of liquidities. So at that time we can see there is a, it is very easy for you to understand. Okay, the supply is at the same rate, but the demand for the fund is now increasing, so the interest rate is increasing. That's why the interest rate is determined at one level. Okay, so hope that part is clear. Is that okay?
Yes, ma'am.
Is that all right now? Okay,
Yeah.
now let's the other way around. Okay, then what will happen if the supply is increasing here? Now that supply is increasing, then demand, that the same level of that, let's say that compared to the deficits banks, there are more banks are having surplus of liquidity. So that we can see the supply of fund is now more than the demand of fund. Okay, so the same demand curve here, but now we can see the supply has increased. So what will happen? The demand is at the same level, but the supply has increased. So what will happen? The more supply is than the demand, so that the price is getting down. That's how that I2 is there. The interest
Okay.
rate is coming down, than the level of policy interest rate by the interest central bank for the deficit facility. So that's what you can say. That here I hope that now you can understand how the market interest rates can be fluctuated in the short term market. That part is clear, no?
Yeah,
Okay,
ma'am.
hope that part is clear for you all. So now then let's see, if the rates are going up or down beyond this corridor, what will happen? That it is matter actually for the central bank. Why? That policy interest rates are lower than these rates. That here, that you can see, that here you can see that the in the short term market, that interest rates are now not within the corridor, but central bank no need to do anything. I said you know, that in case here the passive role is there for the central bank. So what will happen then? Then now we can see that here why the interest rate has increased, because that more demand is there. When the demand is increasing, while the supply is remain unchanged, the interest rate has increased. Here the case. So, but at that time, that demand is high, mean that there are more borrowers. So the borrowers are going, they have to borrow at I1 level. But do you think that borrowers are going to borrow at that rate? Not all the banks, even they are having deficits. All the banks, they no need to borrow at this much of a high rate, because why? Already the facility is available for them to borrow from the central bank at 6% level, which is lower than this level. See that here in this axis also the interest rate is here, so that you can see set over time, that it is set fixed. So you can see, so that these banks, if these banks are rational and if they have the securities which are acceptable by the central bank as collateral to lend them, that they are not going to borrow from another commercial banks, instead that they are come to the central bank to borrow. Okay, so at 6% rate. So accordingly we can see in this market what will have. Now there are no that much of high demand, because some of the commercial banks are coming to the central bank to borrow. So this demand is gradually decreasing. So this line is gradually move here and will set the market interest rate, adjust the short-term market interest rate again. So likewise, the same thing happen. Okay, can you understand that part?
Yes.
I think that that yours is not that much sound. Huh?
Yes, ma'am.
Okay, so will I explain this other part as well? Then it will be concrete. Okay, so let's see that here that we saw that now the supply is higher than the demand. That's why that interest rate has come down. So at that level, more suppliers are there, but they have to supply their funds at I2 level. But it is not good for them. It is not favorable for these the commercial banks who are having excess liquidity, because why? That the rate is very low, the return is very low. Okay, but it is favorable for the demanders. Okay, so who are going to borrow from the other excess commercial banks. So what these excess banks will do, that they can see that commercial, that they can deposit that money at 5% rate, which is which will give them high return than this I2. So this is also the interest, this is also the interest that you can compare. This level is lower than this level. So these suppliers, those supply, not the suppliers, so the commercial banks who are having the surplus liquidity, that they will go and deposit their money in the central bank on overnight basis at 5% rate, which will give them high return. So what will happen in the market? So that much of supply is not there anymore, because some of the banks will, that they have moved into the central bank side, so that the supply function is going back. Okay, shifting up here. Okay, that supply increase means supply function is coming down. So now that some of the banks that have the central bank, so that again this curve is coming here. So likewise, again this interest rate will move up and set in between this corridor. So that's what the that this is actually, as I told, that this is very simple way that I can describe you the process. Okay, so that you have to understand when central banks set these policy interest rates, how these policy rates are influenced to the short-term market interest rates. That's what you have to understand, because I have to tell all the stories, because otherwise I just, if I just tell you that this is the policy interest rate set by the monetary policy authority, monetary authority. So accordingly, short-term interest rate will fluctuate between these two range. You can't understand. That's why I just wanted to explain all the stories, the way that it will happen. But in practical, that process is more complicated than that, right? But now you can have an overall idea about the way how the central bank policy interest rates influence on the short-term market interest rates. So always short-term market interest rate will adjust. There are fluctuations here and there, up and down, but this short-term market interest rates will adjust in line with the policy interest rates. So always that short-term interest rate is there in between the policy interest rate corridor. Why? Because of the behavior, as I explained to you. Okay, now, is that clear now?
Yes,
Is
ma'am.
that clear? Okay, so I think for today that we can discuss up now, because time is up. So there are some more things that we have to discuss. So don't worry, we have time. In the next session we can discuss. But I just wanted to make sure whether you can understand. Even though I'm describing, but you cannot understand anything, means no point of moving fast. Okay, so okay, hope that you understand up to this level, so we can discuss the rest in the next session. Thank you so much. Shall we conclude here? Are there any more problems? Let me check the no more questions. So shall we wrap up?
Thank you, madam.
Okay. Yeah, thank you. Thank you so much. Thank you. Thank you. We'll meet again in the next session on next Saturday. Thank you.